Welcome to today's deep dive. Today we're looking at something that honestly sounds suspiciously like a late-night real estate scam, but it's actually a verified financial time machine.
Yeah, it really does sound too good to be true, when you first hear it.
Right, because when you hear the phrase, like real estate cheat code, your first instinct is probably just to roll your eyes.
Yeah.
You assume someone's trying to sell you a course on, I don't know, buying private islands with zero money down.
Oh, exactly. The internet is full of those gimmicks.
It really is. But we're setting all that aside today to look at a highly specific, entirely legal strategy that can literally turn the clock back to the housing market of a few years ago. We're talking about taking over someone else's incredibly low mortgage rate.
Which is arguably the most powerful, yet probably most widely misunderstood financial mechanism available in real estate right now.
Yeah, and it's not some new loophole, right?
Not at all. I mean, it relies on standard government programs that have existed for decades. They're just, well, they're kind of hidden in plain sight.
So to understand how this actually works on the ground, we're diving into this incredibly detailed breakdown. It's called the Assumable Mortgage NC 2026 Triad Buyer Savings Guide.
Right, and it's an excellent resource.
Yeah, our grounding source today was put together by Teresa Overcash. She's a licensed instructor and a broker owner at Realty ONE Group Results. And she brings like 30 years of hard-fought experience navigating real estate in the North Carolina Triad, Wilkes County, and the High Country.
Which is so important here. I mean, we're looking at a source who has overseen over 10,000 closings.
That's a massive amount of real-world data.
It's vital, honestly, because what she brings to the table isn't just, theoretical economics.
Right.
She's providing the raw, verified math and the actual line-by-line contract mechanics of how these assumable deals are successfully closed or, frankly, how they catastrophically fail in 2026.
And for you listening, that is exactly why this particular deep dive is so critical. I mean, the headline alone saving nearly $300,000 in interest, that sounds like an absolute no-brainer.
Oh, absolutely. It's a huge hook.
But as we're going to see, stepping into this time machine involves navigating some pretty severe turbulence.
Yeah, it is not a walk in the park.
Right. There are these hidden traps involving massive upfront cash requirements, completely locked veteran benefits, and these ticking legal clocks that can swallow your non-refundable deposit before a bank even opens your file.
Okay, let's unpack this. What exactly is the mechanical process of an assumable mortgage, and why does the math make it so incredibly tempting to try?
Well, the core mechanism of an assumable mortgage is actually quite elegant. Basically allows a home buyer to step directly into the seller's shoes regarding their debt.
Okay, so skipping the usual bank process.
Exactly. Usually when a house is sold, you go to a bank, originate a brand new loan at whatever today's interest rates happen to be, and use that new money to pay off the seller's old debt.
Right, that's the standard way.
But an assumption bypasses that entirely. You inherit the seller's original interest rate, their remaining loan balance, and crucially, their remaining amortization timeline. I like to think of it like passing the baton in a relay race.
Oh, that's a great way to put it.
You're like, the seller has already run the first grueling leg, right?
Right.
They secured this amazing loan back in, say, 2021, and they've been paying it down.
Right.
And instead of them dropping that baton and forcing you to start a brand new race from the very beginning with a heavier, more expensive loan, you just grab their baton and keep running. You maintain all that financial momentum they already built.
That analogy perfectly captures the structural advantage, especially regarding the timeline. I mean, you aren't just getting their low interest rate.
You're skipping ahead.
You're skipping the first few years of the amortization schedule, yeah. The first 5 years of a standard mortgage are so heavily front-loaded with interest payments.
Oh, yeah. It feels like you're barely making a dent in the principal at first.
Exactly. So by stepping into year 6 of their loan, a much larger percentage of your monthly payment goes directly toward actually paying down the principal balance.
So let's ground this in the numbers Teresa Overcash provides for August of 2026, because the momentum you're inheriting here is staggering.
The math is really where it shines.
It really is. So let's look at a verified scenario for a typical purchase in, like Winston-Salem or Greensboro. First, the baseline. If you're financing a $340,000 new loan at the current Freddie Mac average, which she notes is 6.67% as of August 13, 2026, you're signing up for a 30-year commitment.
Right, a standard 30-year fixed.
Yeah. And your monthly principal and interest payment on that brand new loan is going to be $2,187.
Okay, now contrast that with the assumption scenario.
Let's hear it.
Let's say you find a seller with a VA loan from a few years ago. It's locked in at 3.25%, and there are 25 years remaining on the term.
Okay, so roughly $340,000 balance.
Yep. If you assume that exact loan, your payment drops to $1,657.
Wait, so we're talking about $530 saved every single month.
Every single month.
That is over $6,300 a year staying in your pocket, not going to a bank.
And the macroeconomic impact over the life of that loan is immense. I mean, you're avoiding roughly $290,000 in interest.
$290,000.
Yeah. Plus, back to your baton analogy, because you stepped into a loan that's already been paid down for 5 years, you will own the house free and clear 5 years sooner than if you'd started a new 30-year term.
$290,000 isn't just a slight market discount. That is generational wealth.
Absolutely.
That funds college tuitions. It maxes out retirement accounts, which honestly immediately makes me skeptical. If the savings are this massive and mathematically undeniable, why is this treated like some underground secret?
What's fascinating here is the sheer gap between what is legally possible and what is actually executing in the market.
Okay, what do the numbers look like?
According to the data in our source, roughly 24% of outstanding U.S. mortgages right now are assumable.
Wow, almost a quarter.
Yeah, a quarter. These are your government-backed loans, VA loans, FHA loans from the Federal Housing Administration, and USDA loans from the Department of Agriculture. Nearly a quarter of the market holds these.
Okay.
Yet assumptions make up under 2% of actual home purchase activity.
Wait, I want to make sure I heard that correctly. Almost a quarter of all active mortgages in the country can legally be assumed, but they represent less than 2% of sales.
Yep, under 2%.
The disconnect there is massive. Why aren't people doing this?
It is entirely driven by a lack of education across the industry. Buyers simply don't know they have the right to ask for it.
Just ignorance of the option.
Basically. Furthermore, real estate agents on both sides of the transaction often don't understand the underwriting process well enough to suggest it, or they mistakenly assume their clients wouldn't qualify.
Right, because most loans don't allow this, do they?
You have to understand that conventional loans, the standard loans backed by Fannie Mae or Freddie Mac, they dominate the market, and they contain a strict due-on-sale clause.
Which fundamentally prevents the baton pass.
Exactly.
Like the moment the title of the house changes hands from the seller to the buyer, that clause triggers, and the bank demands the entire loan be paid off in full immediately.
Precisely. Because conventional loans are securitized and sold on the secondary market with different risk profiles, the lenders want to constantly reprice debt to current market rates.
So they enforce the due-on-sale clause to get their money back and loan it out higher.
Right, but government-backed loans like FHA and USDA are structurally designed to promote long-term homeownership and community stability.
Because the government is the one backing it.
Yes. Because the government is insuring the risk, they explicitly do not include a due-on-sale clause. The door for assumption is permanently open.
Okay, I hear that, but I have to play the skeptic for a moment, because this still sounds a little too frictionless.
Fair enough.
If you're listening to this, you might know how FHA and VA loans function at a basic level, right? The Federal Housing Administration requires just 3.5% down, and Veterans Affairs loans famously require 0 down.
Right, they're known for low entry barriers.
So am I really just walking into a house in the triad, putting 0 money down, and walking away with a 3.25% interest rate today?
You've hit on the exact reason this strategy is largely inaccessible to the average first-time buyer.
I knew there had to be a catch.
That is the catch Teresa Overcash refers to as the cash trade-off. You are assuming the remaining loan balance, yes. But the seller isn't giving you their house for merely the debt they owe.
Oh, right. Because the house has gone up in value.
Exactly. You also have to pay the seller for the equity they have built up in the property, and you have to do it in cash at the closing table.
Ah, the reality check. So the house hasn't been sitting in a time capsule. It's appreciated in value over the last 5 years.
Significantly.
So the seller is essentially asking you to cash them out of their investment gains just so you can take over their favorable debt.
That's the mechanism. Let's look at the reality in the North Carolina triad market right now. Sellers who bought between 2020 and 2022 experienced massive, historic appreciation.
I mean, housing prices exploded everywhere.
They did, and today, those specific homeowners typically have somewhere between $60,000 and $180,000 in equity.
Wow.
And you, as the buyer stepping into their shoes, must bring that equity difference to the closing attorney.
So just to be clear, If the house is currently valued at $400,000 and their remaining assumable loan balance is only $300,000, I have to hand the seller that $100,000 difference out of my own pocket.
Out of your own pocket, yes.
Well, that completely changes the profile of who can actually pull this off. This isn't a hack for a cash-strapped buyer at all.
No, not really.
This is a highly strategic game for the cash-rich.
It absolutely transitions into a wealth deployment strategy. Now, some buyers do attempt to bridge that massive equity gap by taking out a second mortgage or like a home equity line of credit on the property they're buying.
To cover the cash difference.
Yeah, but layering secondary financing behind an assumable first mortgage introduces complex subordination agreements, and honestly, many loan servicers flat out refuse to allow it.
They just won't do the paperwork?
Practically speaking, assumptions overwhelmingly favor buyers who are sitting on strong, liquid down payment savings.
But let's follow that thread. Say you do have that kind of cash, maybe you just sold your previous home and you have like 60 grand sitting in the bank, you still face a significant strategic dilemma regarding opportunity cost.
You do, and the source breaks down the math on this opportunity cost brilliantly. Let's examine a $425,000 purchase.
Okay.
If you walk into a bank and take a new FHA loan at today's 6.67% rate, you only need to part with a 3.5% down payment.
Which is pretty manageable.
But if you want to assume that seller's 3.25% VA loan, you might need to bring an extra $62,500 to the table just to satisfy their built-up equity.
So you're rapidly draining your liquid savings account just to buy access to the low interest rate.
Yes, but evaluate the return on that drained liquidity.
Okay.
By choosing to put that extra $62,500 down, you are saving $11,777 every single year in mortgage payment.
Which is huge.
Divide that savings by your cash outlay, and that equates to an 18.84% annual yield on your money.
Wow. An 18.84% yield.
Yeah.
And it's guaranteed because it's realized in immediate payment reduction. You would be hard-pressed to find any index fund or high-yield savings account that promises a risk-free return approaching 19% right now.
Exactly. From a pure balance sheet perspective, for a buyer who has the cash reserves and no better deployment vehicle for that money, it is a phenomenal financial victory.
It's a slam dunk.
But, and Teresa Overcash makes this a crucial caveat, you have to view this holistically.
Right.
If tying up that $60,000 leaves you entirely broke, like stretching your last dollar to cover closing costs with zero emergency fund remaining for a broken HVAC system or medical bill, it might fundamentally be smarter to keep your cash liquid.
Because life happens.
Exactly. Maintaining your financial safety net by taking the new 6.67% rate, even with the higher monthly payment, could save you from financial ruin.
You can't live inside a spreadsheet. Liquidity has its own inherent value.
Very true.
Okay, so cash solves the equity problem for FHA and USDA loans. As long as you meet the standard debt-to-income and credit requirements, you can assume those. But earlier you mentioned VA loans are a huge piece of this puzzle, and that brings up a completely different, much higher barrier.
Here's where it gets really interesting. The single biggest misconception regarding this entire strategy is who can actually assume a VA loan.
Okay.
The assumption across the industry is that Veterans Affairs implies a strict military requirement.
Right, that you have to be a veteran.
But the reality is you absolutely do not have to be a veteran to assume a VA loan.
Wait, really? A completely civilian buyer with zero military background can step in and take over a 3% VA loan?
Entirely legally, yes.
That's wild.
Any buyer with acceptable credit can assume it. The process is slightly different. You don't apply with a brand new lender of your choice. You must apply directly with the seller's current loan servicer.
So the bank that currently collects their payments.
Exactly. That specific servicer runs the credit and income underwriting on you, the civilian buyer, to ensure you can afford the payments.
That sounds like an incredible loophole for the civilian. But if I take a step back and look at the whole board, this raises an important question. What actually happens to the veteran seller?
Oh, man.
Like, does the Department of Veterans Affairs just shrug, clear the books, and let the civilian walk away with the government-backed perk?
That question cuts to the heart of the most devastating trap in this entire process. A trap that costs uninformed veterans dearly. When a veteran seller allows a non-veteran to assume their loan, the seller can and should request a release of liability from the loan servicer once the buyer is approved.
Okay, meaning if I, the civilian buyer, lose my job 3 years from now and default on the mortgage, the veteran's personal credit score isn't destroyed by my foreclosure.
Correct. The release of liability shields their credit. But, and this is the vital mechanism, it does not restore the seller's VA entitlement.
Let's explain what that entitlement actually is, because it's not just a vague concept.
Right. The VA doesn't actually lend the money to the veteran. They guarantee a portion of the loan to the bank, usually about 25% of the loan value.
Okay, so they're co-signing, essentially.
Kind of. That specific dollar guarantee is the veteran's entitlement, and it is the mechanism that allows them to buy a house with zero down payment.
Because the bank feels safe.
Exactly. Because the bank knows the government will cover a quarter of the loss if things go bad, the bank doesn't require a down payment.
So the government has pledged a specific dollar amount of backing for that veteran.
And here is the trap. That entitlement guarantee stays permanently locked to that specific loan and that specific property until the loan ceases to exist. It remains trapped until the loan is paid off in full, refinanced out of the VA program, or sold to another eligible veteran who formally substitutes their own entitlement for the seller's.
So if a civilian buys the house and simply assumes the loan to keep the low rate, the veteran's guaranteed benefit is still anchored to a house they no longer own or live in.
They're completely sidelined. If that veteran gets transferred to a new city and tries to buy their next family home, they cannot use their zero-down VA benefit because it's still active on the old property.
That's awful.
Teresa notes that an alarming number of veterans only discover this structural reality at the closing table when it's too late. Or worse, months later when a lender in their new city denies their new loan application because their entitlement is empty.
That is genuinely tragic. A veteran thinks they're doing a smart thing, passing on a great interest rate to get their home sold quickly, and suddenly they're penalized by having to scrape together a 20% conventional down payment for their next house, simply because their benefit is hostage to the civilian they sold to.
It creates massive friction in the market. It means that while a civilian can legally execute this, finding a veteran seller who understands the consequences and is still willing to sacrifice their future entitlement is a steep hill to climb.
I can imagine. Who would agree to that?
Practically, this strategy only works if the veteran seller is retiring and not planning to buy another home, or if they have accumulated enough cash from the sale to easily afford a conventional down payment on their next property without needing their VA benefit.
So let's say you miraculously thread this needle. You're a cash-rich buyer who can cover the equity gap. You found an FHA loan, or you found a veteran whose specific life circumstances mean they don't need their entitlement restored right now.
You're ready to sign.
You are ready to ink the deal.
Well, the paper you sign next could cost you everything if you don't understand the timelines.
So what does this all mean for the actual real estate contract? How do you legally execute this assumption without exposing yourself to massive financial risk?
It fundamentally comes down to a structural clash of timelines between standard real estate law and bank bureaucracy.
Okay, break that down.
When you enter a contract to buy a house in North Carolina, the state uses a standard due diligence window. This is your protected period to get structural inspections, finalize your financing, and decide if you truly want to proceed.
Right.
Usually, in a competitive market, that window is only about 21 days. If you walk away during those 21 days, you lose your negotiated due diligence fee, but your larger earnest money deposit is fully refunded.
That's standard practice.
Yeah.
21 days to get your affairs in order. If you walk away on day 22, the seller keeps your earnest money. But how long does it actually take a loan servicer to process and approve an assumption application?
Between 60 and 90 days.
That is a terrifying mismatch.
Yeah.
It's like trying to catch a slow-moving train before the station doors lock on you. Why on earth does it take them 3 months?
You have to look at the financial incentives of the bank. When a servicer originates a brand new mortgage at 7%, they generate thousands of dollars in origination fees and highly profitable debt.
They're making money.
Right. When they process an assumption for a 3% loan, they are severely restricted by law on what they can charge, often capped at a mere $900 administrative fee.
Oh, wow. So there's no profit in it for them.
None. They are being asked to do the full underwriting work of a new loan for a fraction of the revenue, all to maintain a low-yield asset on their books. Naturally, they are entirely disincentivized to move quickly. Your file goes to the absolute bottom of the pile.
So as a buyer, your 21-day due diligence window slams shut, and your thousands of dollars in earnest money becomes completely non-refundable, potentially months before you even find out if the servicer is going to approve your credit.
Exactly.
You are flying blind with your cash completely exposed. Doesn't the state provide a standardized form to protect buyers from this exact scenario?
They do offer a form. It's called NCAR Form 2A6T, the Loan Assumption Addendum. It's produced by the North Carolina Association of Realtors, and it is referenced right on page 1 of the main purchase contract. But Teresa Overcash issues her most stark warning on this very point. Relying on Form 2A6T on its own is a recipe for disaster.
Because the standard form fails to resolve the timeline clash.
Precisely. The standard checkbox form is merely a starting point. It does not adequately redefine the due diligence boundaries.
So what do you do?
If you want to survive a 90-day processing slog without risking your deposit, you must have attorney-drafted language added to the contract. You will need a custom addendum that specifically ties the refundability of your earnest money to the servicer's actual final decision, completely decoupling it from any fixed calendar date.
You're forcing the seller to agree to terms that say, like, I do not forfeit my deposit until the bank explicitly says yes or no, regardless of how many months they drag their feet.
And that custom language must strictly define what a denial actually means. Is it a denial based on your credit score? An income ratio denial?
What if they just ghost you?
Exactly. What legally happens if the servicer simply fails to process the paperwork by a stated deadline? Your closing attorney must draft these contingencies before you sign the initial offer. If you just check the box on the standard form, your deposit is entirely at the mercy of an underfunded, unmotivated servicing department in another state.
The margin for error here is razor thin, which really highlights why utilizing an experienced real estate broker and a competent closing attorney isn't a luxury. It is the absolute baseline for survival.
Absolutely. Don't try this alone.
Assuming you have your legal shield ready and your cash in hand, how do you actually locate these properties in the triad? Because you can't just open a real estate app and filter by 3% interest rate.
The search process requires genuine effort. The standard MLS does have an assumable checkbox that agents can select when entering a listing, but it's notoriously unreliable.
People just forget to click it.
Listing agents frequently forget to check it, or they deliberately leave it blank because they just don't want to navigate the complex timelines and paperwork we just discussed.
So if the primary database is unreliable, where do you hunt?
The inefficiency has spawned dedicated platforms to bridge the gap. The guide highlights platforms like Rome, which currently aggregates about 8,000 assumable listings nationwide and helps cover agent commissions.
Okay.
Alongside AssumeList, which boasts very strong coverage specifically for identifying VA loans. But if you want the ultimate local hack for the triad market, you have to stop looking at property features and start looking at regional migration patterns.
Migration patterns. How does understanding demographics lead you to a cheap mortgage?
You have to look at the massive military footprint in North Carolina.
Oh, right.
The guide points out that the highest concentration of assumable candidates in the triad are properties currently owned by military families who are relocated from Fort Bragg up to Winston-Salem or Greensboro between 2020 and 2022.
Oh, that makes perfect sense. Think about a hypothetical family stationed at Bragg who got transferred to Greensboro in 2021.
Right. They moved during the pandemic when rates were at rock bottom. They bought a home using their zero-down VA loan, locking in a 2.75 or 3% rate.
Wow.
Now, 4 to 6 years later, military reassignment cycles mean they are likely getting orders to move again.
They have to sell.
They're sitting on a locked-in low rate, and they've built up perhaps $100,000 in equity. They need to sell. You don't wait for them to list the house and hope their agent checks the right box on the MLS. You hire an agent who actively networks and searches for that specific cohort off-market.
You are hunting for the specific life event that forces the assumable opportunity to the surface. You're analyzing the financial mechanics of the seller, not just the square footage of the house.
Exactly. It's a totally different way of hunting.
Okay, let's pull all these threads together because the landscape we've mapped out today is complex. For you listening, the overarching takeaway is that assumable mortgages are not an urban legend. They are a mathematically proven, highly legitimate vehicle to save hundreds of thousands of dollars on a home purchase right now.
But they demand an incredibly specific buyer profile to execute safely.
Exactly. You must possess the liquid cash reserves to cover the seller's equity, which in the triad realistically means bringing $60,000 to $180,000 to closing.
Yep, the cash trade-off.
If you're targeting a VA loan, you have to carefully navigate the reality that the veteran seller is permanently sacrificing their zero-down entitlement if you as a civilian are not substituting your own. And above all else, you absolutely must deploy an ironclad, attorney-drafted addendum to protect your deposit money from the glacial pace of bank servicers.
And it is worth noting that assuming a loan does not bind you to it forever, if macroeconomic conditions shift and market rates ever drop back below, say, 5%, you retain the right to refinance that assumed loan just like any standard mortgage.
Oh, that's a good point.
You're simply utilizing the assumption to secure a lower cost of capital while you wait for broader market conditions to improve.
If we connect this to the bigger picture, it really forces a paradigm shift in how we fundamentally value real estate. As buyers and their agents become more educated about the mechanics of this strategy, an assumable 3% mortgage stops being just a line item on a piece of closing paperwork.
It does.
It's rapidly transitioning into a highly valuable, tangible asset in its own right.
It acts as an attached amenity, much like a newly renovated kitchen or a premium lot location.
Right.
But its value is entirely unique because it actively pays the buyer a dividend every single month in the form of reduced interest overhead, which leaves us with a fascinating, provocative thought to consider as the housing market evolves over the next few years.
What's that?
As the friction decreases and assumption platforms become more mainstream, are we going to see the emergence of two completely different asking prices for the exact same physical property?
A bifurcated pricing model. Would that actually look on a listing?
Well, imagine logging onto a real estate portal and seeing a listing with two distinct tiers. There's the standard asking price for the physical bricks and mortar, say $400,000, if you intend to bring your own expensive 7% financing to the table.
Okay.
But right below it, there's a premium VIP price, perhaps $40,000 or $50,000 higher if you want the golden handcuffs of their 2021 interest rate legally transferred to you. In that scenario, you're no longer just purchasing the physical shelter, you are explicitly purchasing the financial time machine.
The debt itself becomes the product being sold, and the house is just the vehicle carrying it. That completely upends traditional valuation.
It really does.
Well, for those of you listening, whether you are actively hunting for a real estate cheat code, looking for a smarter way to deploy your cash reserves, or just trying to understand the hidden currents of the housing market, the lesson is clear. Keep questioning the consensus. Dig into the raw data, find the local experts who actually understand how the systemic plumbing works, and never assume that the standard, heavily marketed path is your only option. Thanks for joining us on this deep dive. We'll catch you next time.